Great. Thank you, everyone, for joining tonight. We're going to be covering a lot of material, and I hope it will be helpful. So let's get started. So when we do financial aid presentations, I always have some goals that I'm hoping everyone is going to remember from it. And so I want to just highlight some of the big picture things that I hope everyone will take away at the end. When we're talking about financial aid, what really matters is gift aid. That's grants and scholarships. It's money that you don't have to repay. And a lot of people often kind of confuse work study and loans with financial aid. It's best to just focus on grants and scholarships. Another thing that's very important is that almost all gift aid comes directly from colleges. So a lot of people say, well, we'll apply for scholarships and see if we can pay for college that way. Unfortunately, because most of the money does come from colleges, it makes sense to apply for outside scholarships, but they usually don't amount to more than 500 or 1,000 or 2,000, which certainly is good, but it's not going to solve your paying for college problem. Now, when you're thinking about paying for college, what you really want to focus on is the net price. That's the starting cost of a college minus the amount of gift aid, and we'll talk about that in detail. How much gift aid your student gets depends on your student's profile in terms of eligibility for need-based aid and academic, or what are also called merit scholarships, and the way colleges award aid. So if you have high need, but you're applying to a college that doesn't award a lot of need-based aid, that's not going to be a great outcome. If you have no need, and you're applying to colleges that award only on the basis of need, you're going to end up paying the full price. Another important thing, unless your student applies to affordable colleges in the fall, having affordable choices in the spring is a matter of luck. And so we want to make sure that you can help your students structure their list so that there are affordable colleges on it at the time that your student makes a decision about where to apply. And finally, the question of affordability is different for everyone based on the student's net price and the resources the family has available to pay the net price. So with that said, our agenda tonight is two big topics. One is assessing where you might get aid, and the other is deciding what you can afford. When I say you and where you might get aid, what we're really talking about is the student. And that's a question of identifying the student's profile in terms of eligibility for need-based aid. That's going to be filing the FAFSA and the CSS profile. It will determine your EFC. And then if colleges meet need, that can be a good match. The other thing you're going to be wanting to do is to assess your students' potential eligibility for merit scholarships. That's typically grades, test scores, and so on. And again, you want to try to identify colleges that might award merit aid if that seems to be a way that you're going to get more financial aid. Deciding what you can afford is making sure that you're clear on the true total cost of a degree, understanding the resources that you have to pay the cost, and typically that's going to be savings and money that you can pay out of income. Thinking about how much you're going to have to borrow if the resources you have aren't enough, and critically making sure that the amount that you borrow is reasonable. So we'll talk about all these things. First of all, let's talk about the net price, the true cost of college. When most people think about the cost of college, they think about the sticker price, which is about $23,000 at USM. It's about $26,000 at Orono. It's $57,000 at University of New England. and about 74,000 at Bowdoin. But it turns out that colleges have a lot of gift aid that they award. And the average amount of gift aid at USM is a little over 10,000. It's about 9,000 at Orono, 21,000 at UNE, and 48,000 at Bowdoin. Now that's the amount of gift aid that goes to students who receive aid. And that means that those students who are receiving aid pay about 12,000 at USM to as much as 36,000 at UNE on average. However, not everyone gets gift aid. So at USM and Orono, it's 88 and 99%. 100% of students at UNE get some type of gift aid. Only 52% of students at Bowdoin do, which means that 48% of the students at Bowdoin are paying that full $74,000 a year. So when you do the arithmetic to figure out the average net price for all students, whether or not they receive aid, it ranges from 12,000 at USM, 16,000 at Orono, 36,000 at UNE, and 49,000 at Bowdoin. So the reason that I go through this is because it's really important that you focus on the specifics of the amount of the gift aid that your student is going to get. It doesn't matter what colleges charge. What matters is what you pay, and what you pay is going to be your net price. That's the college's starting cost minus your gift aid. So there are two main categories of financial aid. One of them is gift aid. That's free money, and that actually reduces the cost of college. Typically, need-based aid is called a grant, and merit-based aid is usually called a scholarship, although there's some interchangeability in those terms. The other category of financial aid is called self-help, and this doesn't reduce the cost, but it does help you to manage it. So self-help includes work study, a job that a student gets on campus during college, and it includes loans, money that you borrow to pay the college bill, but has to be repaid with interest after college. So when you think about these two categories, it's pretty clear that free money or gift aid is better. But colleges, unfortunately, don't always make it easy to distinguish the different types of aid. So this is an example of an award letter. It's several years old, but unfortunately, it's still pretty representative of what colleges send to people to communicate how much financial aid they're going to get. And if you look at this award letter, it looks like about $22,000 in aid, which is great. $22,000 is a lot of money. But it turns out that of the 7 line items on this award, only 4 of them are gift aid, 2 of them are loans, and 1 of them is work study. So if you do the arithmetic to separate out and distinguish these different types of aid, it turns out that the gift aid is about $15,000, the loans are $5,500, and work study is $1,800. So $15,000 is still a lot of money, but it's not as good as $22,000, obviously. And there's some important information that's missing. Specifically, the starting cost or the list price and your true cost after subtracting the gift aid. Well, I went online and I looked up the starting cost and the for this college, and it turns out that the starting cost was just under $50,000, $49,765. When you subtract the gift aid of $14,900, that means that the net price for this student for 1 year at this college is $34,865. So keep that in mind. We're going to come back to that number at the end of the evening. But first, I want to talk a little bit more about the different types of gift aid. So we said there are 2 types. One of them is need-based aid. And that's typically called grants. It's based on family income and assets. And in order to qualify for gift aid, you need to file the FAFSA at all U.S. colleges. The FAFSA is required for gift aid and loans at all U.S. colleges. In addition to the FAFSA, there's a second financial aid application called the CSS Profile. That's required at about 150 colleges. That's actually a relatively small proportion out of the total number of colleges in the US. But because the colleges that use the profile tend to be the most generous and they tend to be the best known high profile colleges, there is a good chance that you will encounter the profile as you go through the financial aid process. The other type of gift aid is merit aid, and that's typically called scholarships. The factors that go into it are things like grades, test scores, class rank, the strength of the student's curriculum, and so on. Now, merit scholarships are often awarded automatically when the student is admitted to a college. So the college will send a message saying, congratulations, you've been admitted to our college, and we're going to offer you X amount of dollars in merit scholarships. However, you always want to check on the college's financial aid website to make sure you understand what types of aid are available and how to qualify for the maximum amount, because there are some types of aid that do require additional applications. And obviously you want to put yourself in a position to maximize the amount of aid that you get. So let's focus first on need-based aid. We said that's typically called grants, and this is the algebra portion of the evening. Need in the financial aid world is defined as COA minus EFC. COA stands for cost of attendance, EFC is expected family contribution. This is your potential eligibility for aid. It's the maximum amount of need-based aid that you might receive, but it isn't necessarily the amount that you will receive. So COA stands for cost of attendance, and that's always made up of 4 elements: tuition and fees, room and board, books and supplies, and transportation and other miscellaneous expenses. EFC stands for expected family contribution. And this is one of the most misleading acronyms in the English language, because if you read those words, it makes you think that's what you're going to pay for college. The reality is that very few people actually pay their EFC. They may pay more or they may pay less, but it's rarely the EFC. All the EFC really is a way of ranking families based on the income and assets that they have, and then putting all of the students who are applying to college in order in terms of the economic strength of the student and the parents. Really important point. College aid awarding policies vary. Some colleges meet full financial need based on the FAFSA or the profile EFC. Other colleges meet little or no financial need. So if your student has high financial need, then applying to a college that meets full need could be really important in getting a good financial aid package. If you're interested, you can estimate your EFC at this website. And if you do, it's going to be helpful, but it's not going to be sufficient. So what do I mean by that? Well, let's say that you go to this website and you find out that your EFC is 30,000. Well, that tells you that at the University of Maine, you're going to qualify for no need-based aid because your EFC is higher than the cost of attendance. On the other hand, at Bowdoin, you might qualify for as much as 45,000 in aid. Bowdoin's cost is about 75. You subtract your EFC of 30, and the difference is 45,000. Another key point, each college defines its idea of need, and that idea of need is rarely the same as the family's. So we said that EFC determines eligibility for need-based aid. A lower EFC means greater eligibility for aid. There are two EFC formulas, one based on the FAFSA and one based on the CSS profile, but they both use the same basic approach, which is to look at the income and assets of the parents and the student. So they're actually doing 4 separate calculations in the background. They add up the subtotals of each of those calculations, and that total becomes the EFC. One thing that I want to point out here is that for most people, income plays a much bigger role in determining the EFC than assets do. So people often worry that their assets are going to hurt them for financial aid. It's true that they count and it can be a bit of a factor, but for most people, income plays a much bigger role. That's because once you reach a certain relatively low threshold of income, every additional dollar of income adds about 50 cents to the EFC. Once you reach a threshold for assets, every additional dollar of assets adds a nickel to the EFC. So income has a much bigger role in determining the EFC than assets do. Now, we've been talking about the parents so far. For the student, the contribution from income is determined pretty much the same as it is for parents. Most high school students don't have significant income, so that's usually not a big factor. Sometimes students do have assets in their name, though. And if they do, that can be disadvantageous in terms of eligibility for need-based aid. Student assets are assessed at a rate of 20 to 25%. So if the student has $1,000 in his or her name, that's going to add $200 to $250 to the EFC. If that $1,000 were in the parent's name, it would only add a maximum of about $56 to the EFC. It turns out that there is a loophole, and unlike most loopholes, this one is available to ordinary people. If you happen to have assets in the student's name, if you liquidate those assets and put them into a student-owned 529 account, there's a special exception, and student-owned 529 accounts are counted as if they were a parent asset. So that moves them from the 20 to 25% category into the 5 to 5.64% category. Now, you do want to pay attention if you're doing that. If you liquidate the assets, it could generate some tax implications. So you always want to think about the big picture before you do anything for financial aid. But that could be a way to help reduce your EFC and make yourself eligible for a little bit more need-based aid. There are some special cases in calculating the EFC. And one of them is when there are multiple siblings in college at the same time. Now, as of now, the parent portion of the EFC is shared among those siblings, which means that if you have 2 siblings in college at the same time, the EFC is significantly reduced for those 2 siblings compared to if they were going to college sequentially instead. Now, that's going to be changing, and I'm going to discuss that a bit. The law was changed at the end of 2020, and so the FAFSA rules are going to be changing in 2024. So I'm going to go over that in a couple of minutes. Another case is when your income changes. So when the EFC, when you fill out the FAFSA and the CSS profile, you're going to be reporting income that was earned in the past. Sometimes your circumstances might change. Maybe you lose your job. Maybe there's a death in the family or divorce or something like that. In those cases, what you do is you report the information as it is asked for on the form, and then you get in touch with each college that your student is applying to and say, hey, I reported my income as it actually occurred during the year you asked for, but my circumstances have changed. Here's the new information. can you please consider me for additional aid? In those cases, colleges have the ability to give you more eligibility for aid. They're not required to, but most colleges will consider it and often make you eligible for more aid. The final special case I want to talk about is when the parents are divorced or separated. And here, the way the FAFSA and the profile work are quite different. The FAFSA looks at the custodial parent only, and if that parent has remarried, it will look at the new spouse's information also. The profile looks at both biological parents, and if those parents have remarried, they will also look at the new spouses. Now, the profile has some calculations that are going on in the background that are intended to put the primary responsibility for college on the biological parents, but those calculations are pretty crude and imperfect. So it can be quite disadvantageous from the standpoint of need-based aid if the student's parents have remarried. I don't want to discourage you from marrying for love, but for financial aid, it may not be the best. So we said that the FAFSA and the profile are looking at income that was earned in the past. And here's an example of how it works for current juniors who will graduate with the high school class of 2023. For the first year of college, they're going to be looking at income for the year that ended 2 months ago, December 2021. You're going to be filing your taxes in a couple of months. Your student will apply to college in this coming fall, so the fall of 2022. That's probably also going to be the time that you complete the FAFSA and the CSS profile. And then during the winter and spring of 2023, colleges will notify the student of whether they've been accepted and also how much financial aid they might receive. Assets are valued as of the date that you filed the form. So for students who are in the class of 2023, that's probably going to be this coming fall. And that gives you a little bit of an opportunity for planning to perhaps make yourself eligible for a bit more need-based aid. If you have expenses that you know you're going to need to pay, it can be better to pay those expenses before you file the FAFSA rather than afterwards. So obviously you don't want to spend money foolishly, but for example, if you pay estimated taxes, maybe you're self-employed, it might be advantageous to pay those taxes a little bit early and then file your FAFSA after you've paid the taxes so it's no longer in the bank. So that could be an opportunity for planning. As you go through the college process, you're going to have to file for financial aid each year. So we said for the class of 2023, for the first year of college, they're going to be looking at 2021 income. For the second year, 2022, for the third year, 2023, and the fourth year, they'll look at 2024. Now, if a student is fortunate enough to have a grandparent or another relative who wants to help pay for college, the timing of when the relative makes those payments can make a difference. It turns out that the final income year that's going to be looked at for the FAFSA and the profile is the year that ends when the student is a sophomore in college. If a relative makes payments to help pay for college, those payments are considered untaxed income to the student and could impact the eligibility for need-based aid. But if you wait until after January 1st of the student's sophomore year, the final year for income consideration will have passed, and therefore those payments from relatives will no longer have an impact. This is something where I mentioned some of the FAFSA rules are changing. This also is going to be changing, but it may or may not impact your planning. So let's talk about those FAFSA changes in a moment. I'm going to be happy to email the slides to anyone who asks for them. And in addition to the table of years for juniors, there's one for sophomores and another for ninth graders. So let's talk about the changes that are coming to the FAFSA. This is going to be effective for the academic year 2024-2025. That means that juniors who graduate in the high school class of 2023 are going to have 1 year using the old FAFSA rules and 3 years using the new FAFSA rules. When those new rules come into effect, most income items are going to be imported directly from the IRS. That's going to make it a lot easier to fill out the FAFSA because most of the types of income information that you enter, you'll be able to populate in most cases automatically from your tax return. In addition, that term EFC, which I dislike so much, is going to be called the Student Aid Index, which it's going to function the same way in terms of arithmetic. Cost of attendance minus Student Aid Index will still indicate how much financial need there is, but it's not going to be quite as misleading. Another change for the FAFSA is that if parents are divorced, the way you determine which is the custodial parent is going to change. Right now, the custodial parent is the parent with whom the student lives more than half the time. Beginning in that 2024-25 academic year, it's going to be the parent who contributes more toward the student's cost of living. Now, in many cases, that's going to be the same as the parent with whom the student lives, but it could be different. So that could be a complicating factor in the future. For the FAFSA, college payments from relatives will no longer count as student income. So a lot of people are thinking, well, those grandparent payments that you talked about, it's no longer going to make a difference. But wait a minute, because I'm not sure that that's going to be the same for the profile. So we'll talk about that in just a second. The other thing for the FAFSA is the discount for multiple siblings in college simultaneously is going to be eliminated. So the EFC will no longer be reduced using the FAFSA if there are two or more siblings in college at the same time. What's going to be the impact of these FAFSA changes? Well, the big beneficiaries will be very needy students. It's going to be easier for them to complete the FAFSA, and it's likely they'll qualify for more aid. So it's going to be a benefit for students with a great deal of financial need. A really crucial question, though, is what's going to happen to colleges that use the CSS profile? And the reason for that is that the most generous need-based aid comes from colleges that use the CSS profile. At these colleges that use the profile and are generous with need-based aid, the maximum annual aid you can get based on the FAFSA is about $7,000 to $10,000, depending on which state you live in. The maximum aid you can get based on the profile, though, could be as much as $70,000. So that profile can have a much bigger impact on how much aid you get than the FAFSA. So a crucial question is, how are those profile colleges going to treat these new changes? So I think that an educated guess as to that is that profile colleges will treat the custodial parent the same way FAFSA colleges do, meaning that they'll consider the parent who provides the majority of the financial support for the student. That's really not going to have a big practical impact because the profile typically asks for both parents anyway. In terms of not counting payments from relatives, I think it's very unlikely that profile colleges will omit that. I think they're going to continue to consider payments from relatives as untaxed income. So that timing that we talked about, if a student is fortunate enough to have a grandparent who's going to pay, could be very important still. And I think it's pretty likely that many profile colleges will continue to offer a discount on their EFC if there are multiple siblings in college. So that could be an advantage to people who happen to have multiple kids in college at the same time. Another reason why it's so important how the profile reacts to these changes is because colleges that use the FAFSA only often don't meet full financial need. That means that they gap their students. That term means that there's a gap between how much financial need a student has and how much financial aid a college awards. So with all these changes, it's important that you don't get too excited about what's going on and make big plans to change your financial situation to qualify for more aid unless it makes sense for your overall financial picture. So that's really not limited to these changes. That's always the case. Any changes you make to qualify for more aid should be consistent with what's in your best interest for your overall financial planning. All right, so what we've been talking about so far is the student's profile, the EFC, and how much financial need the student has. Let's say that your student has financial need and you want to find some colleges that are likely to meet that need. Well, what you can do is look up statistics on how much need is met. Is there a gap? In other words, does a college meet full need or does it not meet full need? And out of the need that is met, does it meet more need with grants or does it meet need with loans and jobs? It's obviously better to have need that's met with grant aid. So let me show you some examples. This is the University of Maine and the University of New Hampshire. At the University of Maine, the average gap is about 31%, meaning that at the University of Maine, they meet about 69% of need on average. And about 43% of the need is met with gift aid. So a significant portion of the need is met with self-help. Now, for Maine residents, the University of Maine is still going to be affordable, but it's not because they have a generous need-based aid awarding policy. It's because the starting cost is quite low for Maine residents. The University of New Hampshire has a gap of 35%, and it meets only about 34% of financial need with gift aid. That's not particularly generous, and because the University of New Hampshire has a pretty high starting cost, it can often be pretty unaffordable for Maine residents. At NYU, their gap is about 38%, and they meet about 50% of need with gift aid. At Ohio Wesleyan, their gap is 16%, and they meet 72% of need with gift aid. So that's one of these smaller, undiscovered colleges that could be a good deal for people. And at BU, their gap is about 13%, pretty small, and they meet 79% of need with gift aid. At Colby, which along with Bates and Bowdoin is kind of the gold standard of colleges that meet full financial need, there's no gap. They meet 100% of need, and they meet 97% of need with gift aid. So if you want to check out colleges, you can go to this website on the College Board, and they've got a lot of statistics about the percent of need met, the amount met with gift aid, and so on. Another important question is, if you do get need-based aid, will it be enough to make a college affordable? So I want to show you an example of a very generous college that meets full financial need. And in this example, the college's cost is $72,000, the EFC is $30,000, so there's $42,000 of need. It turns out that at this college, they meet the first $4,500 of need with a loan. They meet the next $2,200 of need with work study. And then after they've awarded a loan and work study, any remaining need is met with gift aid. So in this case, that's about $35,000. Now, when you subtract $35,000 from the starting cost of $72,000, that means that the net price is about $37,000. So it's about $7,000 more than the EFC. This pattern continues in the second, third, and fourth year of college, except that this college increases the amount of loan that it asks students to take. So by the end of 4 years, there's been a total 4-year EFC of $120,000, total 4-year need of $168,000. The college has met the full $168,000 of need, but because much of it has been loans and work study, the net price is about $153,000. So it's about $53,000 more than the total of the EFC. And I've given you a kind of a simplified example. This is a generous college, but it doesn't include inflation. So if you're thinking about whether need-based aid will make college affordable, here's the rule of thumb. If the EFC times 4 plus about $40,000 is not affordable, then need-based aid probably is not going to be the answer to your paying for college dilemma. All right, so we've talked about the students' eligibility for aid. We've talked about how colleges meet need-based aid. If need-based aid may not be the answer to making college affordable, you might want to consider merit aid. And to think about merit aid, we need to think a little bit first about the business of college, because college, at its bottom line, is a business. Now, most students and families, when they're thinking about colleges, focus on the acceptance rate. That's the percent of students who apply to a given college who end up being accepted at that college. At Harvard, it's 5%. At Northeastern and BU, it's about 20%. At Muhlenberg, it's 62%, 68% at Ohio Wesleyan, and 73% at Susquehanna in Pennsylvania. Colleges do pay attention to the admittance rate, of course, but they also focus on another number, and that's the yield rate. That's the percent of students who were admitted to a college who end up actually enrolling at that college in the fall. At Harvard, 7 out of 10 students who are admitted to Harvard end up going there. At Northeastern and BU, it's about a quarter. And at Ohio Wesleyan and Susquehanna, it's around 15%. Well, when that yield rate gets into the 20s and below, colleges start to worry about, will they have enough students paying tuition to help them meet their expenses? And so what do? They discount their price in order to attract students. And so these final columns, the third column is the percent of students at a given college who receive college-funded gift aid. At Harvard, it's 57%, meaning 57% are aided, 43% pay the full price. The fourth column shows how much non-need, what percent of students received non-need or merit aid. At Harvard, it's 0. Harvard uses only need-based aid. At Wesleyan, it's also 0. Wesleyan uses only need-based aid. At Northeastern, it's 36%. So a third of the students at Northeastern, or more than a third, are getting some type of non-need-based merit aid. At BU, it's 4%, and then at Ohio Wesleyan, it's 28, and Susquehanna is 17. Take a look at that third column, the percent of students receiving college-funded gift aid, because that can be kind of a shortcut to finding colleges that award merit aid. So you can see that there's a pattern. At those colleges that award a high amount of merit aid, the percent of students receiving aid is quite high. So at Ohio Wesleyan, 100% of students receive college-funded gift aid. In Susquehanna and Muhlenberg, it's 95%. So let's talk about that a little bit more. We said that merit aid is typically called scholarships. The student's profile is going to be determined by factors including grades, class rank, test scores. Merit aid is most common at private colleges, but more and more public colleges use it now too. Here's a key point. The highest awards go to the strongest students relative to the other applicants at the school, which means that you are probably likely to get your highest merit awards at colleges you might think of as your safety schools. So your safety schools for admission may also be your safety schools for financial aid. Another key point, college aid policies vary, ranging from colleges that award no merit aid, like Harvard and Wesleyan, to colleges that use primarily merit as the way they award financial aid. So I want to show you some examples of merit aid. And these are pre-pandemic. It's when SAT scores were more universally required, but it shows a pattern that still is in effect. So at Gettysburg College in Pennsylvania, their highest merit award was $32,000, and it went to students who got a 1450 out of 1600 on their SAT. If you look at the 75th percentile SAT score, it's 1410. That means that 25% of the students at Gettysburg scored higher than 1410 on their SAT. And that highest merit award is pegged to an SAT score that's quite close to the 75th percentile. You see the same pattern at University of Tampa and Eckerd. At Gettysburg, the lower merit award of $24,000 goes to students with a 1300 SAT. And you can see that the 25th percentile SAT score at Gettysburg is 1280, meaning that 25% of students at Gettysburg scored less than 1280 on their SAT score. So those lower merit awards are keyed to the lower 25th percentile. It turns out that you can make a generalization from this in terms of merit awards. If colleges use merit aid, the best chances for large awards are when you're above the college's 75th percentile. If a college uses merit aid, the awards may phase out when you get to about the college's 25th percentile. But at colleges that compete aggressively for students, pretty much every student may receive either merit or need-based aid. So we saw many of those colleges that award aid to 95 or 100% of their students. So if you're looking for merit aid, where can you look for that statistic of the percent of students receiving college-funded gift aid? It's on a website called College Navigator that's maintained by the federal government. You can see at Gettysburg College, the percent of students receiving college-funded gift aid is 89%. At Washington College in Maryland, it's 99%. The rule of thumb here is that if that percent of students receiving college-funded gift aid is over 65 to 70%, it's pretty likely that the college uses merit aid as part of its aid awarding approach. If it's over 80%, it's highly likely that the college uses merit aid in awarding its aid. So let's say that you have a student and you want to see if there are some colleges that you might, that your student might get merit awards. And I'm going to show you an example of a student with an 1150 SAT, which is equivalent to an ACT of 23. So it turns out that US News and World Report has a lot of tables that show those 75th and 25th percentile SAT numbers. So for this student, he might want to look at Shenandoah University in Virginia. That 75th percentile SAT score is 1123, which is below this student's 1150 SAT, making the student in line for one of the highest merit awards. And you can see on this table that Suffolk in Boston, Old Dominion in Virginia, and UMass at Dartmouth also have 75th percentile scores lower than 1150. Now, the score doesn't necessarily need to be above the 75th percentile. It can be pretty close to it. And you might not get the highest merit award, but you can often get a pretty significant one. So this student with an 1150 SAT is probably also going to be in line for a pretty good merit award at Pace or Lesley or New Mexico State University. So this is a way to identify colleges that might award merit aid to your student. Another place to get information on merit aid is called the Common Data Set. This is a huge questionnaire that most colleges fill out every year, and it's got all kinds of different data on college statistics. It's not as user-friendly as some of the other things that you might look at, but if you Google the college name that you're looking for, plus Common Data Set, you can usually find it. And when you do, you want to go to section H and look for item H2A, N, and O. N is the number of first-year students who received, who had no financial need and received college-funded merit awards. This happens to be Hofstra University outside of New York. And at Hofstra, 372 students got merit awards. That's about 24% of the students. And the average merit award was about 24,000. So this gives you another place to look if you're looking for merit. So here's a summary of some colleges that may or may not use merit awards. I'm going to show you first some private colleges. So at Trinity in Hartford, Connecticut, about 4% of the students received merit aid. So if you're looking for merit aid, Trinity is probably not going to be that great a place to look. On the other hand, at McAllister and Dickinson, close to 20% of the students got merit aid. And at Fordham and College of Worcester, it's 26 and 23%. You can also see the admit rate, the yield rate, and the percent receiving aid at these colleges. For public colleges, it's a little bit harder to draw firm conclusions because often the statistics are going to be not available to compare in-state and out-of-state students, but you can still get a sense. So at UC Berkeley, 5% of students received merit awards and the average amount was $6,500. What that means is if your student wants to go to Berkeley, pretty much plan to pay the full $69,000 price because Berkeley also does not give need-based aid to out-of-state students. They pretty much reserve their need-based aid for California residents. At University of Maryland, though, there might be some merit aid, and same at University of Rhode Island. At Arizona State and University of Maine, they use merit quite a bit. So you can see that almost a third of the students received non-need merit aid, and well into the 90% of students receive some type of college-funded aid. So here's the takeaway here. The best chance for merit awards are when a college has a relatively high admit rate, a relatively low yield rate, and a high percent of students aided or receiving college-funded gift aid. And the applicant is particularly strong relative to the other students at that college. So if you're looking for merit aid, that's a way to look. So here's a summary of how colleges award need or merit aid. And I've broken colleges down into 4 categories, which I call the elite, the near elite, mid-market, and other colleges. The elite and the near elite colleges use very little merit aid, but they often have very generous need-based aid policies. At the mid-market and other colleges, they typically gap their students. They don't have a lot of, their need-based aid is not as generous as some of those others, but they may use a significant amount of merit aid. It turns out that there are over 2,000 four-year colleges in the US. Only about 100 or 125 are in that elite or near elite category. But there are 2,000 or so other colleges that very often may use merit aid in order to attract students. So if you're looking for aid, there's a good chance that you can find it. All right, so we've talked about need-based aid, we've talked about merit aid. Let's talk now about how to estimate your cost. The way to do it is to use a tool called a net price calculator. Net price calculators are required by law, and the law says that they're supposed to tell you your personalized net price, taking into account the cost of attendance and the estimated amount of gift aid. So even though all colleges are required to have a net price calculator, they are not required to have a good one. Here's how you can tell if it's good or not. If it asks 5 or 6 questions, super easy to fill out, maybe takes 10 or 15 seconds, it stinks. If it asks a lot of questions, if it's kind of a pain in the neck to go through, it's probably asking for enough information to give you a more reliable estimate. And don't get discouraged, because you're going to find that most of the questions are pretty similar from one college to another. So it might take you quite a while to go through the first couple of NPCs that you try, but as you use more and more, you'll find it easier and easier. Another thing about net price calculators is that the output can be a little off-putting, especially if you're not a numbers person. If you find the output to be intimidating, just go back to the basics and remember that the net price is the cost of attendance minus the gift aid. The cost of attendance is always made up of the tuition and fees, the room and board, the books and supplies, and transportation and other expenses. You subtract the estimated gift aid, and the result is the net price. So as long as you keep those basic fundamentals in mind, you'll find that you can use net price calculators pretty effectively. When you do use net price calculators, you want to compare prices side by side, so you're having apples to apples comparison. And here, I want to pause for a second. We've been talking about the money side of college, the financial side, but there's more to college than that. And I'm not advocating that you try to find the cheapest possible college. What I am advocating, though, is that whatever college you choose is one that you are confident is going to be affordable for you and your student. So you want to try to make sure that the academics, that the social environment match your student, but you also want to make sure that it's going to be affordable in the end. So if you use net price calculators, you're going to be able to compare prices side by side and get an apples to apples comparison. So I'm showing you an example of a student with a 15,000 EFC, B minus to B grades, and an 1100 SAT. It turns out that for this student at Roger Williams, the starting cost is $58,000. The student is likely to get a $15,000 merit award, an additional $3,000 in need-based aid for a net price of $40,000. At Shenandoah, the net price is about $36,000. At Wheaton in Massachusetts, it's about $25,000. At Orono, it's $22,000. Bowdoin is $15,000. And USM, living with your parents and commuting, is about $9,000. Now, a couple of things that I should mention. First of all, I know that going to USM, commuting and living with your parents is not an apples to apples comparison to going away to college and living in a dorm. But the reason I put that example on is to remind people that there is an affordable path to college for everyone. It may not be the dream college, but it's much better to get the benefit of that college degree and not be overburdened with debt after you graduate. So I always want to make sure that a student's 25-year-old self is not looking at his or her 18-year-old self and saying, gee, what a bad decision you made. Another thing to point out, Bowdoin's net price here is $15,000, just about equal to the EFC. So that's a great deal financially. But unfortunately, a B minus student is probably not going to get into Bowdoin. So you also need to think about the admissibility. The green colleges here, the dark green colleges, are ones where the student is pretty likely to get into. And the lighter green is maybe not quite as likely a thing, but still a good prospect to get in. All right, so now I want to turn to thinking about how you pay the net price. Remember, college gift aid is already included in the net price. Getting outside scholarships from entities other than colleges is very rare. The net price is going to be paid from income that you earn over time. And there are three sources of income. One of them is prior income, money that you've earned in the past and saved. Another is current income, money that you earn during the college years and can use to pay college expenses. And then the third type of income is future income, money that you earn after college and use to repay debt that you took out to pay for college. So let's take a look at the example we talked about at the beginning of the evening. We looked at that award letter and we saw that the net price is about $35,000. We've got to remember that the cost of a degree is going to be 4 years. So we need to ask, how much are costs going to increase? And very importantly, is the aid that a college offers during the first year of college going to be renewable, and on what terms? Now, need-based aid is usually renewable as long as your family's income and assets remain pretty consistent over time. Merit aid is usually renewable as long as the student maintains a certain GPA in college. However, colleges sometimes will put one-time awards on their letters, on their award letters to first-year students. And it may not be absolutely clear that that award is not going to be available after the first year. So if it is not crystal clear in the award letter how to renew each line item on that award, you want to make sure you get in touch with the college and find out exactly what's required to renew each item of aid in years 2, 3, and 4, so that you can have a totally clear picture of the total cost. So for this example, I'm going to assume that costs increase 2% per year, that the aid is renewable and constant over 4 years, and that the student has $2,000 in savings and the parents have $25,000 in savings for college. Let's look at how to pay for a total degree for this student. That $35,000 a year turns into about $145,000 for a 4-year degree. First, I'm going to look at the student. And this student was awarded $1,800 a year in work study. The student was also awarded a federal student loan. Federal student loans are always the first place to look if you're going to need to borrow for college, because the rates are reasonable. It's automatically available as long as the student files a FAFSA, and there are protections for the borrower after college if he or she gets into trouble. But there are limits on how much you can borrow in federal student loans. And the limits are $5,500 in year 1, $65,000 in year 2, and $75,000 each in years 3 and 4. So that's a maximum of $27,000 in federal student loans that the student can take out. We said that the student has $2,000 in savings. So I'm going to use that first because if you remember, student savings count more heavily in the EFC formula than parent savings. So let's get those off the table, and maybe there might be a little bit more potential need-based aid in years 2, 3, and 4. Next, we're going to assume that the student gets a summer job each year before college. And if the student gets a job that pays $10 an hour and works 40 hours a week for 10 weeks in the summer, the student's going to make $4,000. The student's going to pay taxes, go to Old Orchard once or twice, but the student should still be able to save $2,000 each summer to use for college expenses. At this point, we've used up all of the student resources. So now we need to look to the parents. These parents are going to look at their monthly budget and they're going to say, okay, we think that we can pay $375 a month during the college years to pay for college expenses. That's about $4,500 a year. Next, we're going to look at the parent savings. And if we use $19,000 of the parent savings, we have fully paid for year 1 of this college. In year 2, we're going to use the balance of the savings, the $5,900 that's left. At this point, we've used up all of the parent resources. The only way to pay the remaining balance is additional borrowing. And borrowing beyond the $27,000, I think of as a parent responsibility, because at a minimum, the parents are going to need to co-sign for that loan, and they may often have to borrow it in their own name. So I typically think of any borrowing beyond the $27,000 as a parent responsibility. In this case, the parents are going to need to borrow $15,000 in year 2, $21,000 in year 3, and $22,000 in year 4 to fully pay for this college. So in the end, we have fully paid for college using prior income, current income, and future income. We've ended up with $27,000 in student debt and $58,000 in parent debt. Is that a good idea or not? Well, we don't know. We don't yet have enough information to decide. One of the key things we've got to know is how much are those loans going to cost? Well, federal loans typically carry about a 4.5% interest rate, and they're repaid over 10 years beginning 6 months after graduation. Parent loans carry about a 7% interest rate and also are repaid over 10 years after graduation. At those rates and that payment term, for every $1,000 of student debt, the student is going to have to pay back $125 per year for 10 years. For every $1,000 of parent debt, the parents are going to need to pay back $140 per year for 10 years. So the student has $27,000. 27 times 125 is $3,363 that the student is going to have to pay back each year for 10 years in order to fully repay that $27,000 in debt. The parents have $58,000. 58 times 140 is $8,110 that the parents are going to have to pay back every year. So that tells us how much the debt is going to cost. We still need to think about whether that debt is reasonable. I think that a good rule of thumb is that payments for education debt should not exceed about 10% of gross income. So for the student who's borrowing $27,000 and has annual payments of about $3,400, that student needs to get a job that pays about $34,000 a year in order for the student to limit the education payments to 10% and have 90% of his or her income for taxes, rent, groceries, everything else. Well, the good news is that new college graduates on average make about $40,000 to $50,000 per year. So I think that for a student, borrowing $27,000 is not unreasonable for the payoff that he or she is going to get, the benefit of a college education. For the parents, it's a more difficult question to answer because parents need to think about their other obligations. They need to think about whether they need to help other children with college, and they need to think about retirement. And in this case, I see a big red flag because if you remember, when we talked to the parents about their budget, they said they could pay $375 a month or $4,500 a year for college. What makes these people think that if they can only afford $4,500 a year during college, that all of a sudden after college, they can afford $8,100 a year? So to me, this is a red flag, and this college for this family is not affordable. So one of the questions that I get a lot is, how does everyone else pay? And the answer is exactly the same way we're talking about tonight. You get to the net price by starting with the cost of attendance and subtracting the amount of gift aid that the student might get. So if you select colleges that match your student's profile, you may find some colleges that can award significant amounts of gift aid. Next, you look at the resources you have available to pay the net price. So students, I think, can have $43,000 to pay for college, $27,000 in student loans, $2,000 a year in work study, and $2,000 a year in summer earnings. Add to that what the parents have available in savings and income, and that equals the total resources available to pay for college. If those resources don't equal the 4-year net price, there is a gap. And the only way to fill that gap is to either find a college with a lower net price or take on more debt. So when I work with families, what I try to encourage them to do is to think about their zone of affordability. That's the maximum price that they feel they can pay for a 4-year college degree. And at the other end of it, the parents and the students be in a good position to move on with the rest of their lives. I default to what I call the parent debt-free point. That's the highest point that you can pay for college. The student might need to take out that $27,000 in student loans, but I like to identify the place where the parents don't need to take out any debt. Now, they may decide that a college is worth it, and they might be willing to take on 5 or 10 or some amount of debt, but I always want parents to be fully aware of what they're getting themselves into so that they can really make sure that they're going their student is going to an affordable college. This is how you can identify your zone of affordability. I'm using the example of the parent debt-free point. If you make yourself a table with 2 columns and 3 rows, you're going to want to look at prior income, which is savings for the parents and the student, current income for the parents and the student, and then look at potentially $27,000 in student debt, but try to avoid any parent debt. And that will represent your parent debt-free point. So we're almost done. I want to try to see, hopefully, if we can think about a little bit of perspective as we think about this whole paying for college topic. I often liken it to the stages of grief. And people, when they start to see the numbers, sometimes do go through those stages of grief. If that's going to be the case, get it out of the way early so that you can get to that point of acceptance and then start looking at college with a pretty cold eye so that you can really make those decisions based on the best interest for you and your family. Another thing to keep in mind is that college is important, but it's not the goal. The goal is to set the student up for success in life after college. And if the students or parents are overburdened with crippling debt, that's not going to be a scenario that sets them up for success after college. Another thing to keep in mind is that when you think about your own work life, what you're probably going to realize is that where people went to college makes very little difference in the types of jobs people get. When an employer is looking to hire a new employee, for someone who's 24 or 25, yeah, maybe they'll ask where they went to college. But after that first job, what an employer wants to know is, what are you going to do for that employer? What have you done in your previous work? Not where you went to college. Another perspective is to think about these pretty successful people and look at where they went to college. So Howard Schultz, the guy behind Starbucks, went to Northern Michigan University. Bob Iger, the longtime CEO of the Walt Disney Company, went to Ithaca College. And the current CEO of Hershey Foods, Hershey Chocolates, went to Shippensburg University in Pennsylvania. What do those schools have in common? They are all not the top tier elite colleges that you think of. And they're also not the high price tag colleges that you might think of. And finally, when you think about the cost of college, a lot of people think, well, if we pay more for college, we're going to get more potential earnings after college. And the reality is that that's often not the case. So the mid-career earnings for graduates of Colorado College, Connecticut College, and Allegheny College differ by a maximum of $1,200 a year. But the difference between the high and the low net price is over $100,000. So that's a lot of money extra to pay for not a lot of additional earning potential. So when you're looking, or when your student is looking for colleges, if you want to identify some financial safeties, you can use the numbers that we've talked about tonight to go through this type of analysis and identify your student's profile, match colleges whose aid awarding approach matches that. But there's kind of a shortcut that you can take too, and that's to seed your list with colleges that award differently. And that way, even if some of the colleges aren't affordable, it's likely that some of the colleges will have an awarding approach that matches the profile of your student. So everyone should apply to at least one of their in-state public colleges. And for us in Maine, that means Orono, Farmington, USM. Maybe you apply to an out-of-state public flagship. Often, if you apply to a secondary public college, you can save a lot. So if you look at UMass Amherst, their starting cost is about $52,000. At Worcester State, it's $32,000. So even if you don't get a lot of aid at Worcester State, that might be affordable. If your student has high financial need, looking at some of those highly selective private colleges might be a good match. And if you're looking for colleges that might award merit aid, check out the Colleges That Change Lives website. These tend to be lower profile, often smaller colleges, but they often use a significant amount of merit aid in order to attract students. And keep in mind that if the budget is severely constrained, going to a commuter college always pays off in terms of saving money. You get the benefit of that college degree, and it's generally affordable for everyone. One final benefit that we can take advantage of as Maine residents is if you contribute to a 529 account from the Finance Authority of Maine, if you contribute $1,000 a year to a FAME 529 account, FAME will match $300 a year. So even if your student is already in high school, you might put yourself in a position to get an extra $1,000 or $2,000 by contributing to a 529 account. Plus, you'll have the money that you save available to pay for those college expenses too. So I want to thank everyone for listening. I've got a website with some resources. Feel free to check it out. My contact information is here. Feel free to email me. I'd be happy to send anyone the slides that we've gone over. And I appreciate everyone's taking the time to join tonight. I'm going to stop the recording here.